Welcome to another episode of Rich Dad Stockcast, the podcast dedicated helping you elevate your financial education. I'm your host, Denney, and today we're diving into a topic that's both intriguing and, yes, a bit controversial, the diversification myth. Now, before we dive in, don't forget to like, subscribe, and leave your comments below. Your feedback helps us to continue delivering the content that you want to hear. And also be sure to visit stockcastbonus.com for free access to valuable resources that can take your financial knowledge to the next level. Now, joining us today is Rich Dad expert Andy Tanner. Andy, welcome back to the show.
Oh, Del, I'm excited for this topic. There'll be no shortage of opinions here. I can tell you that. So whether my opinions are right or not, I'll let people judge for themselves. But I feel strongly about this.
I as well, and I can't wait to dig in here. And so let's just start with the basics. You know, the idea of diversification is often thought as the golden rule of investing, right?
Yeah. Oh,
so
geez.
I know. Why now? Can you explain, like, why do some experts like yourself challenge this idea? I mean, most people want to call it the golden rule, but those that are educated may push back on that. What's your stance on it?
Yeah, the person that I decided to study more than anyone else in my asset class. I mean, when it comes to general financial education, by far, my greatest mentor has been Robert and Kim Kiyosaki. They've taught me so much about just generalized principles. When it comes to my specific asset class, when I'm talking about stocks, my North Star has been Warren Buffett because he's the best at that. I think Robert and Kim are the best financial education teachers I've ever met. And I think Warren Buffett is by far the best at investing. Now, he's not the best ever. Let's make that clear. I think the best ever is Jim Simons, who we just recently lost. He just passed. His returns were about triple what Buffett's were. But the fact is, neither of those guys believed in diversification. Neither of them did. And the idea is really the line in the sand on this topic, Del, is whether you're going to be educated or no. And for years and years, there's this idea called the random walk theory, which means, look, no one can predict the market, and everyone tapped out on that idea of no one can predict the market. And therefore, any attempts to predict the market are futile, and they probably result in doing less well than just throwing your money in the S&P and diversifying and letting the market give you what it can. And there's a lot of data to back that up, by the way. That's not just an assumption. If you look at actively managed mutual funds, for example, those guys are terrible. 90% of them fail to beat the S&P. So there's a lot of data to suggest that diversification is the way to go. However, it's really one of education, because the moment you say that I can't beat the market, you're basically tapping out on any type of financial. You're making financial education null and void, saying, look, it doesn't matter what you learn, doesn't matter how much you study or how smart you are, you cannot beat the market. And that's completely false. It's absolutely 100% false. What I am saying is an uneducated person has no chance of beating the market.
Now,
so if you're going to be uneducated and you don't like learning about getting good at this, then diversify and pray, but you'll never be great.
and that was kind of something that I wanted to allude to is, many people are, they have their 401ks, they have their mutual funds, right? They work really hard at their profession. They may be a really good dentist or doctor. They didn't have time to get educated. Their 401k says, hey, just throw it in these mutual funds, diversify. One of these things are bound to go up. What's your pushback to that? Because obviously, I'm a doctor, I'm a dentist, I've got all this time that I've invested in this. I don't have time to do this. People are a lot smarter than me on Wall Street. They know what they're doing. What do you say to that?
I don't say anything to that. I mean, if that's what people want to do, look, the real key to that question, I think, is when you start in your compounding. Look, if you want to start at 14 years old and you want to trust that the market's going to be 8 to 10%, and you stick with that idea and you invest heavily and you keep investing, you're going to be a millionaire. I mean, you're just going to be. It's just how it's going to be. And so, if you're a doctor and a dentist that started investing when you're 14, like Warren Buffett did, and you started buying stuff at 14 and just bought the S&P your whole life, you can go back in time and there's going to be millionaireship in store for you. Is it as good as you could have done? No. The problem I see, though, Del, is most people don't do that. They put their money in mutual funds. And so let's look at how the median guy does. Let's look at the reality of those numbers. I mean, if you want to take a guy who compounded since he was 14 years old, or a gal who compounded, when she was 12 years old, great. They're going to be millionaires someday, and they're going to retire. They're going to be okay. Problem is, people don't do that. They don't. And if you look at where we are now, the median balance of a guy 55 to 64 is about 80 grand. That's the median balance in a 401k is 80 grand. So this person has, less than 10 years to retirement age, and they got 80 grand. That's not going to work. No way. They cannot diversify into this market and say, yeah, I'm going to make it. It's not a solution for them. It's just not. It is just not a solution for those people. They're up in the night if they think something magically is going to, they're going to find a 10 bagger. So that it really is an education issue. If you're going to start this in your 30s or 40s, it's a little bit different story. So it depends on when you're starting. The earlier you start, the less education you would need, and the more you could just depend on general compounding. The later you start, the numbers are against you with compounding because you don't have time.
Gotcha. Now, many investors see diversification as a safety net. What are some common misconceptions about this strategy that people should be aware of?
It's not a safety net at all. When you look at risk, which is the fourth pillar of investing, it's the most important of all four pillars. Risk is the most important thing. To be an investor is to be a risk manager. That's just the truth. That's just how it is. That's just how it goes. And so when you begin to categorize different types of risks, you can go on forever. There is something called geographic risk, where locations, if you're in Florida and there's a freeze in the orange crop, you're in trouble because all the oranges are in that geographical location. There's geopolitical risk with Hamas and Israel and Ukraine and Russia, and oil supplies can be disrupted with stuff like that, and prices, instability in an area. You can have interest rate risk where you have an institution like Silicon Valley Bank that bought a whole bunch of bonds that didn't pay anything, and then all of a sudden the Fed raises rates and they have a run on these bonds, and they can't get rid of them. They can't swap them because their value's been crushed because they don't yield anything. You have obsolescence risk, which is WordPerfect and Netscape and Napster and Garmin and US Robotics, right? I mean, Phil Town wrote a book called Rule Number One, New York Times bestseller, and the biggest stock pick in there was how awesome Garmin was. And no one has a Garmin on their dashboard anymore. There's obsolescence risk. So I could list more of these, right? Time and time again. But we could categorize these risks into two broad categories. One would be what we call non-systemic risk, and one would be called systemic risk. And in my books, what I write about is British Petroleum. BP is their symbol. That really stands for broken pipe now, because if you remember, British Petroleum broke a pipe in the Gulf of Mexico, and it was an environmental catastrophe, right? And their stock went from $60 to $30 in 30 days. It got cut in half. But the rest of the market was fine. Apple's doing fine, Microsoft's doing fine, Goldman Sachs is doing fine, everyone's doing fine. So that was an isolated pocket. Well, if you'd had all your money in all your money in British Petroleum, your wealth just got cut in half. So that's where they say, don't put all your eggs in one basket, right? That's what they say. Don't put all your eggs in one. So diversification offers a protection against non-systemic risk, meaning that if I had 100 stocks and British Petroleum is only one, I'm only losing 0.5% of my portfolio in that tragedy, instead of half if I have all my eggs in one basket, if that makes sense. But what diversification does, though, is it increases what we call systemic risk. Not too long after British Petroleum broke the pipe, we had a subprime meltdown where the S&P lost half. And there was nowhere to hide, nowhere to run if you were spread out and you still lost half. Well, 401ks have absolutely no protection against systemic risk. And if you're like my father and you retire in 1998, and then you have a dot-com bust in the NASDAQ that takes 10 years to recover, you go from 65 to 75 with nothing and no ability to dollar cost average because you have no income. So this idea the idea that diversification is completely ineffective is not a true statement. It would offer some protection against non-systemic risks. But the idea that it's a gold standard or that it's a requirement or that it's the best idea or that it gives total protection is indeed a myth. It is not a true statement to say that a person is protected through diversification, because there's still many chinks in that armor. Many.
So if diversification is not the answer, I would say focused investing would maybe be the answer. What would be the answer to diversification?
I defer to Warren Buffett on this. He has talked about this time and time again. You can find these speeches online. They're absolutely precious. Now that we've lost his partner Charlie Munger, those nuggets of wisdom become more valuable, because you can't go and ask Charlie questions anymore. Everything he's ever said has been said now. And so we cling to these guys that are 100 years old and have a, there's almost centurions. They've been around 100 years. And so you've learned things in that time. So what Warren Buffett says, look, if you, let's say you have 30 candidates and you just spread your money out and put the same amount in number 30 as you would in number 1, he says, in our view, that's just a confession that you don't know about your business. Why in the world? If I were a doctor and I brought in, let's say 20 people that were going to race a marathon, and I was going to pick a winner, I'd take their BMI, I'd take their age, I'd take their heart rate, I'd take their cholesterol, I'd do a flexibility test, I'd hit their knee with the hammer thing, and I'd put them through a physical. And after doing that fundamental analysis, which is a term I use on purpose there, after looking at the fundamentals of what make a healthy human being, I say, we're going to go and I'm going to have someone there that looks like me, that's got a BMI that's pretty high, maybe the cholesterol is higher than it should be, and age. And I'm not betting on me to win that race. I'd be an idiot, because it'd be a confession that I don't know anything about medicine or the human body. Now, I might not pick the winner, but if I put my money in the top 5, I got someone who's going to win that race. I'm going to pick the winner. If you say, look, here's 20 people, if you give me top 5, I'm going to pick the winner, and I'm probably going to pick the guys in the upper quartile, right? Probably am. I might not be able to pick the winner, but I'll know who's in condition to run that race. Well, fundamental investing, analysis is understanding the health of a business, and to ignore that. If you could take the pulse and the blood pressure and the BMI and the blood tests and the A1C, to ignore your ability to get that data and just say, well, I have no idea who's going to win this race, I guess I'll just put money equally on all of them and see what happens and accept averageness, it's a confession that you don't know what you're doing. And that's not my words, that's Buffett's words. He says it's a confession that you don't know what you're doing. It's an education issue. So focused investing starts with fundamental analysis and understanding that you're not picking stocks. You're owning a business, and you're analyzing a business to see if it has a strong moat, to see if it has great financials, to see where it's going, where it's been. That's Warren Buffett investing. It's not diversification. He says it's an answer to ignorance.
An answer to ignorance. I want to dig into the fundamentals more here in a second, but let's take a short commercial break. But don't go anywhere. When we return, Andy will reveal some secrets on how to actually implement what we've talked about, how we do the fundamentals. Stay tuned.
So far, it's been great. I needed a source where I could really enrich my education through stocks. I didn't really have an avenue for it. and it's helped me a lot. The simplicity has really gotten me on the track to where I enjoy the learning as well as it's really solidifying in my mind. And like, they're not just trying to sell you something, they really care about the people that are in the course, and they really do care about you and your personal goals, and what you want to do is to help you and your family and whatever your goals are in life through that. So it's really been great.
Welcome back to this episode of Rich Dad Stockcast. Again, our topic is the diversification myth. Now, before we get back to Andy, remember to like, subscribe, and leave your comments below. Your feedback helps us to bring you more of the content that you want to hear. Don't forget to visit stockcastbonus.com for free access to valuable educational resources to boost your financial knowledge. All right, so let's get back to our guest, Andy Tanner. Now, Andy, we've talked about diversification. We've talked about being more focused, and we started to get into the fundamentals. Now, putting theory aside, let's talk about implementation. So what are some practical steps that investors can take when it comes to looking at fundamentals? Like, what are the fundamentals that we're actually looking at?
Well, I again, I'm going to defer to Buffett, and he's a little coy when he says this. Let's not act like he's not completely brilliant. You know, he once said that the guy with 160 IQ doesn't beat the guy with 130 IQ, because the guy, you know, it's really going to come down to temperament. I looked around like Warren, who has 130 IQ. You know, there's not too many. You know, you got me. I'm probably like a 90, 98 or something, right? I mean, I'm an average guy. But the truth of the matter is there are some simple things, and you can get as sophisticated you want, but if you read The Intelligent Investor by Benjamin Graham, he gives a sample of what a basic formula might look like, and it has to do with earnings, and it has to do with growth mostly. You know, maybe a little interest rate thrown in there, but really, if you look at if a company's earning money and they're having growth, that can be a juggernaut. Look, Warren Buffett said, you know how many companies you really need to be successful in your portfolio? One. There are so many fortunes that have been made on a single company. You know, Steve Jobs made his fortune on one company. Bill Gates made his fortune on one company. Elon Musk has, you know, 2 or 3 that he's done, but he didn't do them to diversify. You know, he didn't say, well, I'm going to do PayPal and then diversify into Tesla. They were chronological ventures. And so you really, you know, Buffett uses Coca-Cola. That's a company you can't kill. It was started in the 1800s. It survived 2 world wars, a Vietnam War, a Gulf War, pandemics. You can't kill it. So when you have earnings of that magnitude, where you're selling 8 billion drinks a day, and you have earnings of that magnitude, there's not much risk in that long term. Now you might have what we call a dip in the market because people are panicking, but that doesn't say anything about the company's performance. It doesn't say a thing about it. The price means nothing. That's just people's opinion of stock traders. So really, you know, if you find, I don't think a person needs 70 stocks or 80 stocks to be successful. You know, there are times where I'll get down to under 20. Depending on where I'm at. And what makes me sell, what makes me get rid of a company is if the fundamentals turn bad. If I see the business no longer looks bright, I'm not going to ride that horse. I'm going to sell it. Ideally, the holding period would be forever because it would do well. But if the fundamentals don't do well, but I'm not going to make my decision based on price. And so the other reason is if I find what's called the BBD, if I find a bigger, better deal, I says, this one's nice, but this one's better. I'd be crazy not to choose the better venture. So when it comes to implementation of focused investing, it starts, in my opinion, with picking your style, whether it be fundamental or technical, and then deciding that you're going to be in the top 20% of those people in terms of education. You're going to get the Pareto principle out. You're going to say, look, if you're going to be a technical analyst, then be one of the best. If you're going to be a fundamental analyst, then go be one of the best, because it's, my opinion, it's not that hard to get in the top 20% because there's so many bad ones and so many people that just try to do it off tips, and they're not serious. What percentage of people, Dell, do you think listening to this podcast Like let's say, I always plug yourinvestingclass.com, right? And I always plug stockcastbonus.com. And they offer very much the same thing. So let's say someone goes to stockcastbonus.com and they spend maybe they spend a day with me for free. That person's going to know more than the person that didn't that fast. I'm going to bet on that horse that quick because he just knows a little more. And how many people have really studied this to where they put an hour a week or 2 or 3 hours a week of study into the markets? Very, very, very few people. We could take a poll right here and say, how many of you studied 4 hours, not listen to a podcast, but like 4 hours of formal instruction on fundamental analysis? Who did that last week? It's an incredibly small number. And yet, how many people have a 401k? Everybody does. It's mandatory. If you have a job, you have one. It's mandatory enrollment for most people. So the ability to get into the top 20% of educated investors is not a high bar. It's not hard to do. A few hours gets it done.
That's yeah. But how many hours did they spend planning their next vacation?
Or their Christmas list, or wherever you want to go. So the way to implement this is you learn about metrics. There's a lot of different ways to measure things like earnings, and they're usually done with ratios. Price is what you pay, value is what you get. So the price is easy. We can see what that is on the chart. But what do I get for that? That is where we do the digging, and that's what those ratios are. Price to book, price to sales, price to earnings to growth. These very simple metrics can tell us a lot. A bottom line tells you a lot. If a company's earning a lot of money, they're often hard to kill. Let me destroy this diversification myth. There is built-in risk management inside of a strong company. They're hard to kill. They have a defense. They have a moat. They're hard to kill. That doesn't mean their prices don't fluctuate. It just means that the company is not going to go away because of a pandemic. Did the pandemic take out some of the weak companies? Probably. But it didn't take out any of the strong ones. They're still there. They're fine. They're resilient. They can survive incredible 1/3 drop in a month crashes because they're resilient and powerful, and there is risk management built in to the strength of a company, where we don't need to diversify across the board. We just don't need to.
What about now going back to, okay, we've crushed diversification. We're becoming more focused. We love a handful of stocks, be it Coca-Cola, Apple, Google, Amazon, whatever it might be, Microsoft. All right, we're all in. We like these stocks. The market dips. What do? How do we hedge ourselves? Do we buy more? Do we put stop losses in? What do we do to hedge ourselves?
That's kind of a tip question, half education, half give me a tip. So I'll go education on there. Look, there's absolutely nothing wrong with doing nothing. Both Munger and Buffett have said, look, here's the deal. If you can't handle a 50% swing in a stock, investing's not for you. If you're not emotionally strong enough to say, look, this company's still strong, and it's this market that's lost their mind. If you can't sit in your chair and see that, then you shouldn't be investing. That temperament is so important. So the first answer is you can do absolutely nothing. The smarter answer is you should buy twice the shares when it dips down because it's on freaking sale. That's what I would say is when it dips, that's a freaking gift. The phrase to be greedy when people are fearful is, Scott, it really has wisdom in it. If people could take the consumption attitude and transfer that into the investor realm and domain, they'd be better off. For example, I can't stand, what is it, Black Friday after Thanksgiving. I won't participate in that stuff. I see these people. I'll go visit my parents or something the next day, and I'll see these people in line at whatever in the morning to get rid of their money as fast as they can to buy stuff that's going to be in a landfill someday cheaper. They can't wait to get rid of their money. They'll stand in line eager, ready to pounce. well, why wouldn't, if you're an investor, why wouldn't you want to pounce under the same circumstances? I don't get it. I don't understand it at all. So when people say, well, what do I do when the market goes down? You have a sale, you buy more stuff. Now, if you want to get more sophisticated, I love the idea of setting up hedges to do what we call delta neutral, that when the market falls, our net worth stays the same. But what happens is I can have a net worth like this or like this, and it's the same average net worth between the two sides. So let's say I have a portfolio here and a hedge here, and they go like this, and the portfolio drops, but the hedge is fine. Well, my net worth is still the same, but now I'm flush with cash, where I can now buy at these low levels, and they come up together. And I think that that's an important thing to know how to do, because we invited our students only. We didn't make this, it's too late to get in, but because by the time this recording is out, the class will be over. But tonight I'm conducting a special session that's going to be 4 nights in a row, and it's called the Ultimate Armor class. And ARMOR stands for Advanced Risk Management and Opportunity Readiness. And what it does is it teaches people how to do what I just described, so you can be flush with cash, and when the market crashes, you can buy more. I would much rather do that with a few solid stocks that I can get on sale. Just go back to COVID and see what you could have bought Exxon at, and see what you could have bought Prudential at, and see what you could have bought Apple at, and see what you could have bought anything at, and tell me you don't wish that you would have loaded up on those companies during COVID when they were decimated in price. These companies were still great companies. Did anyone say, what happened to your cell phone use during COVID? How much did it change during COVID? So you don't want to sell Apple phones, Verizon Wireless, electricity, as a utility owner. You don't want to have anything to do with that. How much did COVID change your cell phone use? None. Pretty simple stuff. So the question was, how do you implement this stuff? You take a course on fundamental analysis, right? You can take mine or someone else's, it doesn't matter. Take a course on fundamental, start learning what a good business looks like. Then you don't need to diversify. Then you can be like that doctor that gets to pick which runners he or she thinks are most likely to finish the race. You would be an idiot to ignore that data if it was available. True. If you could get the BMI, if you could get the blood pressure, and you could get that data on the runners before. I mean, what if you were at the track at Churchill Downs? They're probably all stud thoroughbreds, but man, if you could get a biological blood test and a makeup off those horses and bone density, and just get all of that data before you bet, it'd be a huge leg up if you could get that available. Well, the market has that for you. The market is going to show, they have to, every quarter, they got to file where they are. To ignore that research and call yourself an investor, to me, would be insanity.
I agree. Now, you mentioned Warren Buffett, a quote, be greedy when others are fearful, be fearful when others are greedy.
For sure.
The market's shifting ahead, up, down, who knows, right? Politics come into play. Who knows what happens with the stock market? I love that mindset that Warren Buffett has. Is there any other mindset shifts that we need to make as we prepare for the coming years ahead?
For sure. I think there's some huge opportunity. I mean, I'm not selling my Apple. I've sold some aggressive calls on it, and if I get called out, I may buy them back. I may adjust, but he sold half his Apple. And I'll tell you, often when Buffett sells half, he sells the whole thing. Wouldn't that be something for him to divest himself of where half his money is? Half his money is in Apple, and now he sold half of that. So the amount of capital this guy has to deploy is just sacrilegious. I mean, it is a mountain of money that if you had a pair of skis, it'd take you 2 hours to ski down that mountain of money he's got right now. It's unbelievable. And so that tells me he's not necessarily a market timer, but man, for him to sell that much of a great company and be subject to a capital gain of whatever percent that is, he's got to feel he's going to have a chance to deploy that capital in a powerful way, because inflation is going to kill your your dollar. So he's got to be thinking the assets are going to be in deflation. He's got to be thinking that. And so as you go into the times of turmoil, I don't really look at elections that much. I look at it historically, and politicians want votes, and I don't really care what the rules of the game are. Just tell me what the rules are. I don't really care. Every country you have people with strong personal financial statements, and there's always a way to preserve your own personal financial statement. And so I worry about it socially. I worry about the world my kids grow up in, but as an investor, I don't worry about it too much. If you use sound investing principles, you're going to be fine. But I think risk management is a big deal. I think if you're going to be dependent on your portfolio, you're a little older, and you're going to have to depend on that. That brings some things into play, because if you're forced to sell with a mandatory withdrawal in a 401k, you could be forced to sell at low prices, which you don't want. Buffett doesn't have a 401k. He's not going to be forced to sell at low prices, but people in 401ks might be. So yeah, that's a big deal. I mean, it's time to more. I say it every week. There's never been a more important time to be financially smart ever. I'm trying to learn more. My biggest fear is ignorance in what I don't know. That's my biggest fear. And I've studied this for a long, long time, and I'm still afraid of what I haven't learned yet. So if I'm still afraid of someone who is an intense student, people who are not intense students should be mortified. They should be scared to death. But I don't want to be a fearmonger. That's not the purpose. But it's just the reality. Education is life when you hit rough waters. And I think we got some rough water ahead.
I agree. I always think about fear. Most of the time, fear is just the fear of the unknown. And how do we squash that?
It's outcome.
It's
fear of the outcome. It's not knowing the outcome and having a possibility of a bad one and being afraid of it. That's what it is. And education does a lot to help that, for sure.
Yeah, your fear goes down, your confidence goes up. Well,
Yep.
Andy, that's a wrap for today's episode of Rich Dad Stockcast. We hope everyone has found this discussion on the diversification myth helpful, and a big thank you to Andy Tanner for sharing his expertise with us. Now, remember, whether you're just starting to save or nearing retirement, the key is to stay informed and educated, just like Andy said. And speaking of education, don't forget to visit stockcastbonus.com for free resources that can help you on your financial journey. If you've enjoyed today's episode, please make sure that you like, subscribe, and leave us a comment. Your feedback helps us to improve and bring you more of what you want to hear. Share this podcast with your friends and family to help them to make better financial decisions too. Thanks for tuning into Rich Dad Stockcast. Until next time, get smart, get invested, and get control of your financial future. I'm Denney, and we'll see you on the next episode.
Thanks, Del.
This podcast is a presentation of Rich Dad Media Network.